Welcome back to Calvin Mateo, the channel where we cut through the noise and find the asymmetric opportunities that everyone else is missing. If you get value from this deep dive, do me one quick favor and smash that like button and subscribe so you never miss a breakdown like this one. Now let us get into it. Did you know that a massive structural shift is quietly happening in the stock market right now, creating an asymmetric investment opportunity of a lifetime? Today, we are dissecting a company that has been caught in a massive tug of war between speculative retail trading and sophisticated institutional accumulation. For months, the bears dismissed this company as just another highly volatile Bitcoin miner. But this week, a series of explosive corporate announcements completely shattered that bearish narrative. We are talking about a full-blown fundamental pivot that transforms IREN from a simple asset-light landlord into a vertically integrated, high-margin AI infrastructure powerhouse. If you have been sitting on the sidelines or holding shares with white knuckles, you need to hear this. While the headline numbers look incredible, there is one hidden, massive institutional move we will look at in a moment that changes everything. To see exactly where we stand today, let us look at the immediate price action and the technical level that started this entire upward cascade. If we look closely at the recent numbers, IREN closed the week on Friday, August 14th at $44.06. Now this marks a massive high-volume recovery from its weekly low close of $37.93 back on August 6th. But look at the bigger picture. The stock is still trading well below its 52-week high of $76.87, leaving a massive runway for growth. Our market capitalization currently stands at approximately $15.61 billion, but here is the technical trigger you need to watch, the weekly flipped technical pivot at $42.70. This was our key overhead resistance, but this week the bulls forcefully reclaimed it, turning it into our primary support line. Why is this specific dollar amount so important? Because it represents the exact line where the heavy liquidation pressure we saw last month has finally been fully absorbed by the market. But this explosive recovery was not just a random technical bounce, it was kicked off by a major acquisition that took place on August 4th. On August 4th, IREN officially closed its acquisition of cloud software provider Mirantis. Now the market's immediate reaction was sheer panic, and for a very typical reason, dilution. This transaction was structured as an all-stock deal, which meant issuing roughly 12.6 million ordinary shares, plus paying out $40 million in cash and RSUs at closing. The next day, on August 5th, IREN filed a prospectus to register 11.9 million of those shares for potential resale, creating a temporary $476 million supply overhang that depressed the stock price on August 7th and 8th. Many retail investors saw the word dilution and immediately dumped their shares, but if you actually analyze the strategic logic behind this deal, you will realize those sellers made a devastating short-sighted mistake. If we dig deeper into the actual numbers, we can see why this acquisition is a complete game changer for IREN's profitability. Here is the plain truth that the bears completely missed. The Mirantis acquisition moves IREN directly up the compute value curve. Under the legacy colocation model, IREN acted as an asset-light real estate landlord, simply renting out physical space and raw power. In that commoditized model, you can only expect to generate about $2 million to $2.5 million per megawatt in revenue. But by integrating Mirantis' proprietary software orchestration, specifically the open-source K0RDENT AI platform, directly into their physical hardware, IREN can now operate as a full-stack, vertically integrated Neocloud provider. According to top analysts at Bernstein, this shifts their revenue profile to an astronomical $10 million to $20 million per megawatt. That is a staggering 5 to 8 times revenue multiplier on the exact same physical data center footprint. Just imagine what that does to their margins. And if you want proof that this vertical Neocloud model is actively winning over the largest customers in the world, look no further than what happened on August 13th. On August 13th, IREN delivered a massive execution milestone that completely de-risked their business model. Microsoft formally accepted Horizon 1, a 50 megawatt direct-to-chip liquid-cooled facility at IREN's Childress, Texas campus. This is not just a pilot program. It is the official kickoff of their landmark 5-year, $9.7 billion cloud services agreement. Here is why this acceptance is a massive financial turning point. It officially starts the contractual billing clock. This single 50 megawatt facility is now set to generate roughly $500 million in annual recurring revenue over the next 5 years. At the exact same time, Nvidia tested the facility and granted Horizon One its prestigious Exemplar cloud status on the cutting-edge GB300 NVL72 platform. This elite certification proves to other hyperscalers that IREN can engineer high-density, liquid-cooled compute at absolute scale. Could this be the moment IREN goes from underdog to industry standard? But as impressive as Microsoft's validation is, IREN's stock also received a massive boost from a sector-wide tidal wave earlier in the week. On Wednesday, August 12th, IREN's stock surged 9.86% to close at $43.67. What is fascinating is that IREN did not release a single piece of company-specific news that day. Instead, the rally was driven entirely by a massive sector-wide re-rating. The day before, on August 11th, peer giant CoreWeave reported blowout second quarter earnings, posting $2.6 billion in revenue, raising their guidance, and disclosing a mind-boggling $104.2 billion revenue backlog. The very next day, another competitor, Nabius Group, reported a 454% surge in revenue and flipped positive on adjusted EBITDA. These stellar numbers validated Wall Street's core thesis that the multi-billion-dollar backlogs in the AI infrastructure space are real, highly profitable, and rapidly converting into actual cash. Now, none of this matters if we do not address the massive drag of IREN's legacy business and how they plan to bridge the financial gap. If we are being completely objective, we must acknowledge IREN's historical financial drag. In their most recent reported quarter, ended March 31st, IREN posted a net loss of $247.8 million, heavily weighed down by a $140.4 million impairment charge on decommissioned Bitcoin mining equipment. Total sequential GAAP revenue actually fell from $184.7 million down to $144.8 million as Bitcoin mining revenue slumped 34%. But here is the curiosity gap that short sellers are ignoring. While the legacy crypto business is shrinking, the AI cloud revenue surged 94% sequentially. More importantly, IREN has raised its year-end AI cloud target to a massive over $4 billion in ARR. And get this, 85% of that target is already locked in through long-term contracted agreements. How often do you see a company with that kind of visibility trading at these levels? But to scale up to a $4 billion ARR, IREN has to deploy a massive amount of capital, which brings us to their funding structure. Building high-density data centers is an incredibly capital-intensive game, and IREN's total capital expenditure requirement for Dell GPUs and servers stands at $5.8 billion. Skeptics have argued that IREN will have to dilute shareholders into oblivion to fund this. But if we look at the actual funding structure, we see a highly sophisticated de-risk capital plan. First, IREN's contracts are structured so that customer prepayments cover roughly 45% of the associated GPU capex upfront. On top of that, Microsoft provided a 20% upfront cash prepayment on their deal. To cover the rest, IREN closed a massive $3.65 billion investment-grade GPU financing facility specifically dedicated to Microsoft-linked hardware deployments. This means the dilution risk is heavily mitigated, backed by IREN's solid cash position. But even with this robust funding, some high-profile bears remain deeply skeptical of the entire Neocloud business model. Let us address the bear thesis head-on. Legendary short seller Jim Chanos has criticized Neocloud agreements, arguing they are essentially glorified financing deals where operators like IREN absorb 100% of the long-term hardware depreciation and lease risks, while hyperscalers retain exit flexibility. There is also a real monetization lag because GAAP cash flows will lag behind contracted ARR for several quarters. Short-term dilution remains a risk if capital is mismanaged. Furthermore, achieving that $4 billion ARR target requires absolutely flawless execution. IREN still has to build, test, and hand over three remaining Microsoft phases, Horizons 2, 3, and 4, representing 150 megawatts, strictly on schedule. These are legitimate concerns, and any serious investor has to weigh them. But while the bears are focusing on these execution risks, the smartest institutional investors in the world are aggressively doing the exact opposite. The institutional capital flows tell us a story of massive, high conviction accumulation. Institutional investors now own 41.08% of IREN's total outstanding shares. The most shocking development occurred on August 12th when Goldman Sachs filed a Schedule 13G disclosing a massive 9.4% passive ownership stake in IREN. This is highly significant because Goldman's own research division currently maintains a conservative neutral rating and a $50 price target. Yet their asset management arm is aggressively buying up nearly a tenth of the entire company. Think about that contradiction for a second. They are joined by giants like BlackRock, which increased its holding by 198% last quarter, and Norges Bank, which initiated a massive new position. When the largest institutions on earth are aggressively buying up shares, it creates a powerful structural flaw. Is this the hidden signal the retail crowd is completely missing? And this massive institutional accumulation has created a highly dangerous environment for short sellers who are currently trapped in a corner. This is where the market structure math gets absolutely explosive. As of July 31st, there are 98.22 million shares sold short. That represents a staggering 28.94% of the entire public float. Short sellers actually increased their short positions by 4.81% over the last month, and on average volume, it would take them 1.9 days to cover their positions. Now look at the derivative setup. We have an absolute call wall at the $41 strike with 35,336 open contracts. Market makers hedging these contracts will defend this level, providing a massive downside cushion. Meanwhile, on the upside, we have heavy call open interest at the $45 and $46 strikes. If IREN breaks past $44.50, market makers will be forced to buy millions of shares to hedge, triggering a violent gamma squeeze. Can you imagine what happens to a stock with 30% short interest when that squeeze finally ignites? So, where does Wall Street actually value this stock once this structural squeeze gets initiated? If we look at Wall Street's consensus, the average price target stands at $81.73 to $82.71, representing an implied upside of over 87% from where we closed on Friday. The consensus rating is a solid moderate buy. High conviction bulls are targeting triple digits. Compass Point has set a buy target of $105, and Bernstein SocGen maintains an outperform rating with a $100 price target. Bernstein highlights that IREN's self-owned vertical Neocloud model generates $10 million to $20 million per megawatt, compared to just $2 million for legacy colocation models. Even the cautious bears like JP Morgan Chase have their price targets set at $46, which is still higher than the current market price. When even the bears are pointing higher, that tells you something. With the consensus pointing toward massive upside, let us look at the near-term technical blueprint to find the optimal entry point. Technically, IREN is a highly volatile beast with a beta of 4.29. On the daily chart, the stock is currently trading just below its 50-day moving average of $45.35 to $46.06 and its 200-day moving average of $46.32 to $46.67. However, the stock has forcefully rebounded 20% above its 20-day simple moving average of $38.79. Furthermore, we just got a bullish MACD crossover above the signal line, confirming strong near-term upward momentum. Crossing the 50-day and 200-day moving average cluster is going to act as the primary technical trigger that forces trapped short sellers to cover, sparking a massive upward wave. So, how do we structure a high-probability trade to capitalize on this asymmetric setup? Here is our actionable tactical trade blueprint for the upcoming week, August 16th to August 22nd. Our optimal buy entry zone is between $42.70 and $43.80. This entry range allows you to build a position directly above the massive call options wall at $41 while capitalizing on the prior technical resistance that has now flipped to support. We will place a hard stop loss at $39.50 on a daily closing basis. If the stock closes below $39.50, it invalidates our bullish breakout. On the upside, we have three clear profit targets. Target 1 is at $48.50, which is near the recent peak. Target 2 is at $55, which could trigger a rapid short squeeze. And target 3 is a runner target at $81, capturing the full fair value potential of the stock ahead of the upcoming earnings report. So, what is the final verdict on IREN as we head into the second half of 2026? By successfully delivering Horizon 1 to Microsoft on schedule and securing Nvidia's Exemplar cloud status, the company has completely de-risked its core execution narrative. We have a powerful fundamental engine with a raised $4 billion plus year-end ARR target. We have massive institutional backing, highlighted by Goldman Sachs' new 9.4% stake. And we have an explosive 28.94% short float trapped directly above a massive option support wall. The upcoming fourth quarter earnings report on August 27th serves as the ultimate catalyst. Now, before we wrap up, an important note. Everything shared in this video is for educational and informational purposes only and reflects my personal analysis. It is not financial advice, and I am not a licensed financial advisor. Every trade and investment carries real risk, including the potential loss of your entire capital. Price targets and forecasts are speculative and can be wrong. Always do your own thorough research and consult a qualified financial professional before making any investment decision. So here is my question for you, and I genuinely want to know, if this gamma squeeze ignites the way the setup suggests, do you think IREN blows past its all-time high before the end of the year? Or do the execution risks catch up first? Drop your honest take in the comments below because I read every single one and I love hearing your perspective. If this breakdown gave you a fresh edge on IREN, hit that like button and subscribe to Calvin Mateo so you are first in line when the next asymmetric setup drops. I will see you in